considered as a systematic risk because the price of the Boeing share drops after the accident happens, and that accident is something that this company cannot avoid because it's a natural accident, which is a tangible force. With this tangible force, the market psychology taught that. For example, let me think the natural accident was a wind that made the plane to crash, but the market psychology has been changed and taught that the airplane that Boeing company made is doesn't function properly, or they are not durable. Because of that, the price might drop. This is what we call the price of the share might drop. This is what we call a market risk. So in banking institutions are also some accidents which are created that makes the price to drop, the price of that institution to drop, which is uncontrollable by the company. The other one is a regulatory risk. This is when the government rules changes regarding to the function of our company. So this is the risk that the government prohibits what we are doing or what we have intended to do. So we cannot do that because the regulation has been changed and prohibits us to do. The possibility of that might occur is a regulatory risk. The other one is interest rate risk or funding risk. Interest rate risk is the variability of return arising from the change in the interest rate. As we all know, security prices and interest rates are inversely proportional. Don't worry, I will explain about this. And these risks more directly affect a bondholder rather than an equity shareholders, because bonds directly pay an interest payment and they can be directly affected by interest rate risk. Let us look at the impact. How change in interest rate can affect the bondholder. Example, you can relate this risk with the banks because a bank can issue both bonds and equity securities. So let's say if we buy a bond with 10% interest that pays us 10% interest. I bought a bond that pays me 10% interest from one bank. So after 2 years, the market interest rate increases 12%. A market interest rate is what others are paying related to our bank. No, it doesn't mean related to our bank, but what others are paying in. So others are paying 12%. So after other companies. So after 2 years, if I want to sell my bond, after 2 years, no one wants to buy my bond that pays 10% interest, where the competitors are paying or others bond issuers are paying 12% for their bondholders. So the company I bought share bond paying 10%. However, most of other companies are paying 12%, which is 2% greater than the bond that I hold. So if you are not familiar with this term bond, I have a video on that clearly specifies how debt market works. I will put the link in the description and you can click here also. So as the demand for our bond decreases because it pays 10% when others are paying 12%, so the demand for our bond will decrease. Nobody wants to buy our bond. If I wanted to sell my bond on the secondary market, the demand for that bond is low because the person who bought my bond receives 10% periodical interest rate. But if he bought that bond from other person, he might get 12%, which other companies are paying. So the demand for our bond decrease. So you can say that the impact is direct on bondholders and bigger compared with the impact on the shareholders. Let's look at the impact on the shareholders. Shareholders sells their share and buy bond instead if the interest rate of the bond is increased. This results the share price to decline. However, the impact here is indirect and small compared with the impact on the bondholder, which is direct impact. So if the investor which holds a share heard that the market interest rate has increased, which most